Hey everybody, welcome back to my YouTube channel. So in this video, we are going to be talking about financial analysis.
So today we are going to be looking at financial analysis. Alright. So this will be a full tutorial on financial analysis. So in this video we are going to be talking about financial ratios, financial analysis. As you can see, if you actually look here by the left hand side of the whiteboard, you can see the table of contents. So we are going to be looking at introduction to analysis, the types of analysis we have, accounting documents for financial analysis. Then we're going to introduce financial ratios. Then we are going to be looking at the different types of financial ratios and how to calculate various financial ratios. Alright. So to start with, let's talk about analysis, introduction to analysis. So when we are talking about analysis, what comes to your mind when you're talking about making an analysis? Maybe you can actually say, okay, I'm going to the markets today. I want to try to make an analysis of the cost of the items I'm going to get. Now, when you're making an analysis, you're actually trying to make findings, right? You're trying to make findings that will enable you to make decisions, all right? So, for example, let's say you're going to the market to actually get an item or a few items, all right? Maybe let's say you want to start up your own YouTube channel, and you actually think, okay, what do I need to actually start up my YouTube channel? And you feel like, okay, I'll be needing a headset, I'll be needing a megaphone, I'll be needing a laptop, I'll be needing a laptop stand, and I'll be needing a mouse on my laptop and the rest of them, alright? So when you're making an analysis, you're trying to make an analysis of what is the cost of these items, okay? You're trying to make a decision of what is the cost of these items, which brand of this item am I going to go for? Okay, let's say you want to get a headset, alright? You're going to decide, am I going to go for a Sony headset, alright? Or am I going to go for an Oraimo headset, okay? So this is actually how you actually make decisions, alright? So you can, during this analysis, okay, you can actually decide, okay, because of the price or price difference, okay, or because of the durability, you can actually decide to go for a Sony headset instead of an Oraimo headset. So that is what analysis is all about. When you're making analysis, you're trying to make findings, all right? You're trying to understand situations, you're trying to make decisions, all right? Now, actually, you're trying to make strategic decisions, okay? So let's just take a few notes. Let me go ahead and increase this so you can actually see it properly. All right. So what is analysis? So like I mentioned, when we are talking about analysis, we are actually trying to make a decision, okay? So analysis is a process of assessing various situations or options in order to make strategic decisions. Okay. So now when you are actually making an analysis, you are actually trying to make a decision from various options. All right. We're trying to analyze, okay, what is the difference between a Sony headset and what's the difference between an Oraimo headset? Why should I get an Oraimo headset or a Sony headset instead of an Oraimo headset? Why should I get a big headset instead of a smaller headset? Do I need a microphone for my YouTube channel? What is the issues of this megaphone? Did I get a megaphone? Can I start without a megaphone? So when you're actually doing all these things, you're trying to make an analysis, all right? And the major aim of making analysis is actually to enable you make strategic decisions, all right? Because analysis is not complete until it helps you to make a decision, all right? Like the example we are talking about, you starting a YouTube channel, all right? You'll be trying to be deciding which megaphone you should go for, which laptop brand you should go for. Should you go for a MacBook or should you go for a HP laptop? Should you go for should you go for a small laptop or should you go for a bigger laptop? All right. So you try to understand which laptop will actually help me make better video editing, which laptop will actually make my YouTube video editing process easier and faster. All right. So when you're doing all these things, this is what we call trying to make an analysis. We're trying to assess different options, different situations, all right, in order to settle or make the most strategic decision. So this is actually what analysis is all about. Now, let's go about the types of analysis. Okay. So one thing you need to understand is that we have two major types of analysis. All right. So we have two major types of analysis. So we have two major types of analysis. The first type of analysis we have is the accounting analysis. Accounting analysis. Now, when we are talking about the accounting analysis, what are we trying to say? All right. Now, when you're talking about the accounting analysis, this is the type of analysis that is actually performed in order to note of or in order to find out accounting errors. All right. So when you are performing accounting analysis, okay, you are either trying to look at financial records, all right, to ensure that they are properly recorded. They are recorded following the accounting concept and conventions. They are recorded thoroughly. There is no omission of figures. There is no addition of figures. All right. So when you're talking about the accounting analysis, we are trying to actually analyze financial records, all right, to ensure that they are free of financial errors. So let's go ahead and take a note. So accounting analysis can be defined as the process of analyzing accounting records to ensure that the information or figures are properly recorded or pre-recorded without any error, and that they follow the accounting concepts and conventions. All right. So basically, this is actually what accounting analysis is all about. All right. So the second type of analysis we have is called the financial analysis. Financial analysis. So now when you're talking about financial analysis, another name for financial analysis can also be called managerial analysis. All right. Now when you are actually performing financial analysis, what are you trying to do? All right. The main aim of performing financial analysis is to enable a company, an organization to make managerial or business decisions. Okay. So now when you're talking about financial analysis, you're actually trying to analyze different financial records from different views, okay, in order to know, okay, the stand of the business, in order to know the credit worthiness of the business, in order to know the investment credibility of the business, okay, in order to enable the companies make strategic decisions, okay. Like I mentioned earlier, the sole aim of analysis is to be able to make decisions, okay. Analysis is not complete until it actually helps an individual or an organization make a decision. All right. Now, when we're talking about financial analysis, here you're actually looking at analyzing two different financial statements. Okay, it could be your cash flow statement, it could be your balance sheet. Okay, right here we are trying to analyze two different statements from maybe analyzing the balance sheet of a company from last month and the one of this month in order to actually understand if the business is actually making profits, if the business is actually progressing, or if the business is actually not progressing. Okay, so that is actually what financial analysis is all about. And like I mentioned, another name for financial analysis is managerial analysis. All right, so let's go and take a little note. Financial analysis can defined as the process of using financial data or financial statements to assess companies performance and give suggestions for future improvements. Okay? Financial analysis can be defined. Alright. So now, this is what I'm trying to explain. Financial analysis can be defined as a process of using financial data or financial statements to assess a company's performance and give suggestions for future improvement. Now, please go ahead and highlight this here. Okay? So let me highlight this with yellow. Okay? So I want you to pay attention to suggestions for future improvements. Remember, I mentioned that financial analysis or analysis is incomplete until it actually helps an individual or an organization make decisions. Okay, so as you can see, this is saying suggestions for future improvement. This actually means helping the company make strategic, managerial, or business decisions. All right. Now, when we go ahead and when you go ahead and analyze the bank statements, okay, let's say maybe the balance sheet of a company. Maybe you go ahead and analyze, or let's just say the income statement of a company. You are analyzing the income statement of a company from last month and this month. Okay. Now, when you try to compare these two financial statements, okay, you try to understand which month, okay, the company actually has the highest profits, okay, and which one the company actually has maybe the highest expenses. All right. So when you're able to actually analyze these two different income statements for two different months, all right, you'll be able to advise the company on what they can do to actually increase profitability, what they can do to actually decrease expenses, and what they can do to actually move the company forward. All right. So analysis is incomplete. Okay, it actually helps the company or an individual make strategic decision. All right. For example, there's a student that is actually trying to go into the university. Okay, maybe he decided to, maybe he feels like, oh, should I study medicine or should I study computer science? All right. He would like to make an analysis of maybe going around to check at how much a computer science student is earning or after graduation, or and how much a medicine student is earning after graduation. We also go ahead to look at the financial cost of studying each courses. All right. We also go ahead to look at the years required, all right, to graduate from each studies of each courses. All right. This will actually help the individual to make a decision. All right, whether should you to go for medicine or to go for computer science. All right. So obviously in our daily lives, all right, whether consciously or unconsciously, we always make analysis even without knowing. Whether you can decide, oh, should I go for the party today or should I just stay home? What is the cost of attending this party tonight? Why should I attend this party tonight? What am I going to lose if I attend this party tonight? Or should I just stay home and work on my assignment? Should I just stay home and work on my project? Alright, so this analysis, alright. So every day of our lives, unconsciously, we all make analysis, alright? Because without making analysis, you cannot actually take decisions in life, alright? You need to actually make analysis to know the benefit of an action and the cons and pros of an action, all right, before you can be able to decide whether to take that action or not, all right. So that is what analysis is all about. Okay, now let's go ahead and move this down a bit. Let's move this here. Let's move this here. Let's move this here. So now let's move this here. All right. Let's go ahead and take this. So another thing we have to look at is let's look at types of financial analysis. All right. So financial analysis have various types. Okay. So the course of this video, we are going to be looking at three types of financial analysis. All right. So the first type of financial analysis we are going to be looking at is the horizontal analysis. Horizontal financial analysis. And the second one we are going to be looking at is a vertical financial analysis. Then the next one we're going to be looking at is the actual versus budgets financial analysis. Alright, so we are going to be taking these three types of analysis. Let me go ahead and increase this for better view. Okay, I'll decrease it later. Just reduce it a bit again. So we are going to be looking at these three types of analysis. Alright, so we are going to be explaining these three types of analysis adequately. Now, what is horizontal analysis? Okay, so what you need to know that horizontal analysis can also be called trend analysis or time series analysis. Alright, so why is it called trend or time series analysis? It is actually because when you're performing a horizontal financial analysis, you're actually trying to compare financial statements of a company over a long period of time. All right, it could actually be annually or it would actually be quarterly. Okay, so when you're performing horizontal analysis, okay, you're actually trying to compare the financial statements of a company over a long period of time. Okay, so when we're talking about horizontal analysis, one thing you need to understand is that horizontal analysis is the major type of financial analysis that company performs. Okay, and when you're carrying out horizontal analysis, okay, it actually helps us to actually spot trends. Okay, like for example, if we are comparing the financial statement of a company quarterly every 6 months, okay, it helps us to know the months in which the company spends more. It helps us to know the months in which the company incurs less expenses. It also helps us to know the company months in which the company makes more profits and the months in which the company experiences a slowdown in profits. All right. So this is actually what horizontal financial analysis is all about. Okay. It actually involves the process of comparing, all right, or analyzing the financial statements of a company, all right, over a long period of time. Okay. It actually helps the company, all right, to actually understand their stand, okay, to understand, to actually notice trends, all right, maybe to notice maybe when customers are actually patronizing them more, when customers are actually patronizing them less. So this is actually what horizontal financial analysis is all about. All right, so now let's go ahead and take a note. Like I mentioned, this is also called time series analysis. Or trend analysis. Okay. That's the one. Analysis. Okay. So this is actually what horizontal analysis is all about. All right, sorry, I think this is seasonalities. Seasonalities. Okay, so this is actually what horizontal analysis is all about. Okay, so when you are performing horizontal analysis, you are actually trying to compare or analyze the financial statements of the company over a long period of time. All right, One thing you need to understand is that horizontal analysis is actually used by companies that have been operating for a very long period of time, maybe for a period of 2 years, 3 years, 4 years, 5 years, and above. Okay, so this is actually where you use horizontal financial analysis. Okay, because when you're using horizontal financial analysis, you're actually trying to know, we are actually trying to compare let's just we are trying to compare 6 months back statement of a company. Okay, so when you compare 6 months back statement of a company, you try to know their net profits for each month. Okay, their gross profits for each month. Okay, you try to know their total expenses for each month, and liability for each month, their assets for each month. Okay, so this is actually what you try to look at. Okay, so by comparing the bank statement or balance sheet of for 6 months, okay, you recognize trends, you recognize seasonality, you recognize maybe the company has a profit, the company kept making profits, okay, for the 6 months. Okay, or you come to realize maybe there was a month when the company experienced a slope down in profits. Okay, so this is actually what horizontal financial analysis is actually all about. All right, so the next thing we're going to be looking at is vertical financial analysis. So what you need to understand is that vertical financial analysis is actually the opposite of horizontal financial analysis. All right. So now, what is vertical financial analysis? So one thing you need to understand is that vertical analysis is actually similar to horizontal analysis, but they are very quite different also. All right. Now, one thing you need to know about vertical analysis is that vertical analysis can be used internally by the employees of an organization, and it can also be used externally by investors of an organization. All right. Now, what do the investors of an organization use vertical analysis for? All right. So the vertical analysis can actually be used by investors to actually compare 2 or more companies across similar industries. All right, in order to decide which companies to actually invest in and which companies to not invest in. All right. So one thing you need to understand is that another name for vertical analysis is actually called common size financial analysis. Okay. And one thing about vertical financial analysis is that when performing vertical analysis, each item on the financial statement is presented as a percentage of the base amount. Okay. Each item in the financial statement is presented as a percentage of the base amount. Okay. Now, when you're working with balance sheets, the base amount is always the total assets. And when you're working with income statement, the base amount is always the sales. All right. So now let's make an example. All right. Let me just get the text box here. Let's say, for example, we are actually working with the balance sheets of a company in 20, the company in 20, let's say 2020. All right. But let's say that their total assets was, let's say that their assets was 1,014,500. Okay. And let's say their total current assets, let's say it was let's say 500 to 5,000. Okay. Now, if we are trying to actually perform a vertical analysis on this, okay, what we have to do is divide the total assets of the company by the current assets. Okay. Let's just say, let me get my pen too. All right. So this would be total assets divided by current assets. Okay. So now when we actually divide these two, okay, you will see that we will have a total of 0.517. Okay. Let's say approximately 0.52. Okay. So which is equal to 52%. Which is equal to 52%. Alright. So this simply means that, okay, alright, 52% of current assets, alright, makes up the total assets of the company. 52% of current assets makes up the total assets of a company. So this is what I actually mean when I say that each item, all right, in the financial statements, all right, is represented in that represented of the percentage, all right, of the base amount. Okay. And remember I mentioned that in balance sheet, the base amount is always the total assets, while in income statement, the base amount is always the base amount is always the sales, all right? Now let me go ahead and wipe this off. Sorry. Right, so let's go ahead and take a look. So financial analysis can also be called common size financial analysis. It is similar to horizontal analysis, but also quite different. Okay, it can be used internally by the employees of the company, or externally by investors. Investors use the vertical analysis to compare and analyze the financial statements of various companies, or let me just say of two or more companies, in order to make a decision on whether to invest in a company or not. Okay, so we have successfully talked about horizontal and financial analysis. All right, so the next thing we are going to be looking at is the trap budgets, trap versus budgets, financial analysis. When we are talking about total budgets, okay, so we are actually talking about the budgets, okay, that the company actually achieved, okay. While planned budget is actually the budgets, okay, that they expected to achieve, alright. So one thing you need to understand that when it happens every year, we actually have a financial plan, okay. Most big organizations they actually build models, okay, financial models, alright, that actually tells them, that actually help them predict, okay, their revenue for every year, their expenses for every year, their liabilities for every year, and their assets for every year, alright. So based on this modest prediction, alright, they actually draw out the budgets, okay. They actually draw out a budget, okay, that actually guides the company, okay, during its operations, alright. Now let's say for example, the budgeted expenditure per company the budgeted expenditure, let's say 2023, will be equals to, let's say, $30,000. Okay, the actual expenditure for 2024 indicated $20,000. Now, when you go ahead and look at this, you see that in the 20, okay, sorry, 2024, let's say at the beginning of 2023, okay, when this company has actually built their financial models and these models have actually made predictions, okay, using the past financial data, all right? Now, the predictions of this model, this company decided to draw up a financial plan or forecast a financial plan, okay? And they said that, okay, for the year 2023, we are actually expecting to make a financial expenditure, okay, to make an expenditure of $30,000, okay. But at the end of the day, maybe by December 31st, 2023, when the accountants was actually preparing their bank statements, okay, they found out that they actually had an expenses, or maybe when they're preparing their income statements or everything, or whichever statement they actually work with, they actually find out that they had an expenses of $20,000 against $30,000, okay. Now, this is what we call surplus budgets. Alright? This is what we call surplus budgets. This simply means that the budgeted expenditure exceeded, okay, the planned expenditure. Okay. So as you can see now that the difference between the actual budgets and the planned budgets, okay, is actually $10,000. Alright. Okay, now this is what we call variance analysis. Variance analysis. Okay, so what is variance analysis? Variance analysis is simply trying to know the difference between the planned budget and the actual budget. Okay, and also trying to know the reason behind the reason behind the change or the difference between the planned budget and the actual budget. All right. Now, there's another type of budget we call deficit budgets. So now let's make an example. Let's say we have an extra planned budgeted revenue 2023. So let's say to be $50,000, it's $60,000. Actual revenue indicated equated 70. Okay, well, let's not use revenue, let's use liability. Liability. $70,000. Alright, so rather what we call deficit budgets, okay? So you can see for 2023, the company naturally budgeted to have a liability, alright, a total liability of $60,000, okay? But by the end of the year 2023, okay, they were actually preparing the bank statements, okay? They think that they actually had an actual liability, total liability of $70,000, okay? This simply means that their budget was actually below the actual budget, okay? This is actually what we call deficit, alright? There's another type of budget we call the balanced budgets. Let us go ahead and play this one. So we call it the balanced budgets. So let's say revenue, planned budget revenue, budget revenue 2023 equals to $70,000, and actual revenue 2023 was equals to 70,000. Okay, so this is actually what we call balanced budgets. Okay, in any type of accounting, we treat the break-even points. Okay, where the company did not make any profit, or did not incur any loss. Okay, it's actually called the break-even points. Okay, but this now we are talking about the balanced budgets. Okay, as you can see, planned budgeted revenue, okay, was $70,000, okay, and they ended up getting the actual revenue was also $70,000, okay. So it simply means that there is no difference between the planned budget, okay, and the actual budget, okay. So this is actually what we call the balanced budget, okay. Now, what you need to understand is that when we are talking about actual budget, okay, and budget, okay, I actually added the the budget here to actually make it more explanatory. All right. So when we are talking about the actual budget and planned budget or actual budget and budget financial analysis, okay, we are actually trying to understand the difference. We are actually trying to know the planned budget of the company, okay. We're trying to understand if the company actually achieved their planned budget, okay. Now, when we are trying to know the difference between the actual budget and the planned budget, okay, this is actually what we call financial, this is actually what we call variance analysis, all right. We are trying to know the difference between the planned budget and the actual budget, and also the reason why there was a difference between the actual budget and the planned budget, okay. This is actually what we call planned, this is actually what we call variance analysis, all right. So let's go ahead and take a note. Here, each organization, each company draw out a financial plan that shows the projected financial expenses, income, assets, and liabilities. This type of analysis is very important as it helps the company to know if their budgets was achieved or not, and the reason and the difference between their actual budgets and their planned budgets. Okay, the planned budgets. The process of knowing the difference between the plan, the actual budget, and the reason for the difference is called variance analysis. Variance analysis can be favorable or unfavorable. Unfavorable. Unfavorable depending on the case. We have three major types of budgets. We are the surplus, deficits, and balanced budgets. Okay, so this note is actually simply explaining everything I've personally talked about, okay? when he was actually explaining plan budgets versus plan budgets. All right. So, like I said, every year each company go out a financial plan, okay, that shows their budgets, the budgeted financial expenditure. All right. Financial expenditure, income, asset, and liabilities. Okay. So this type of analysis is very important as it helps the company to know if their budget was achieved or not. The difference between the actual budget and the planned budgets. The process of knowing the difference between the planned and actual budgets and the reason for the difference is called variance analysis. Okay. Variance analysis can be favorable or not favorable depending on the case. We have three types of budgets, which are surplus, deficit, and balanced budget. All right. So when we this type of financial analysis is very, very important, okay? Because it actually helps a company to actually better manage their resources, okay? Like, for example, if a company budgeted an expenditure of $30,000 and actually ended up making an expenditure of $50,000, okay? As you can see that the actual expenditure was actually above, okay, way above the budgeted expenditure, okay? So this will actually help the company understand that, okay, they actually spent way above their budget, okay? And they will have to perform a variance analysis to actually know the reason why they actually spent, okay, above their budget, all right, for that year. Was it because they actually incurred new assets, okay? Was it because they actually need to give out more loans to customers, or was it because of any other reason, all right? So this will actually help them better plan their resources, okay? So actually know, okay, how can they actually reduce, okay, expenses, right, for the next year, all right? So this type of financial analysis is actually very, very, very important, okay, for every organization, all right? So the next thing we are going to be looking at is financial ratios.